Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark tells us Canadian equity markets saw a bigger bounce up than their U.S. counterparts. Rick's Picks editor Rick Ackerman likes the U.S. dollar and gold, but worries the debt bubble will crush retiring baby boomers. We'll talk with Ross Clark right after this.
Unbelievable harmony, spectacular performance, the ultimate tribute to the Everly Brothers and Simon and Garfunkel. Bird Dog and the Vintage Electric Band coming to Fort Langley, Mission, White Rock, West Vancouver. Buy online and save at ontourtickets.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Good to be with you, Jim.
The equity markets finally fought back this week and made some gains.
Yeah, that was last Friday when we saw the market make that reversal. It looked like it had the makings of something of significance and ended up with three just fabulous days this week. Market actually in the process of that rally, the Dow and the S&P have retraced a full 38%. That's a nice Fibonacci ratio of the decline from the highs that we saw back in October, November. So it's what we hope to see as part of the basing phase when you are in this presidential cycle that we're looking at. This mid-February through mid-March usually puts in a decent low. Ideally, you want to see it have a close that's below that January mid-month low that we had. So that looks good. The only fly in the ointment on this one on the short term is that the low from a week ago looks to be maybe a little bit premature. Most of the lows tend to be well in place in the latter part of January through mid-March. So I wouldn't be surprised if we still go down and retest the levels that we had on January the 20th. We'll see how things unfold here in the next week and a half or so. But the key will be taking out the resistance that's above us, and if we can manage to do that, then seasonal pressures will carry us into the second quarter, the early part of April, maybe into May.
Ross, what was the big gainer that brought the equity markets back?
Well, it was that crude oil market that turned a week ago Friday and had good follow-through into the middle of this week. You know, we have so many of these things that are just moving in concert with one another. Crude had managed to get back up to about $32 after being down to 26 a week ago. You get this buoyancy that appears quickly and then fades away again. Oil managed to still have a decent week. We closed around $30, still up almost $4 from a week ago, but it seems to be it's also hunting for a bottom in here, and maybe it's got to go back down and retest the $26 level. I really have been looking for this reversal to find decent support and rally back into that mid-30s to $40 level as we move into the spring. But as I say, like the equity market, it's going to take time to build a bit of a base here.
Gold and silver.
Nice follow-through last week on gold as we popped through the 1170 and we got up to 1260. Similar move in the silver, although silver's been underperforming. The gold-silver ratio has been moving more in favor of the gold recently. I was very happy to see that after the hard run that we had, that we gave back so little of it this week. I like to look at Fibonacci retracements, the classic 38 and 62 percenters, but one of the other ratios in there is 23%, and the gold market gave back just a 23% down to $1,200 and held very, very solidly at the beginning of the week and again on a retest on Thursday. So as long as that $1,200 holds in place, then our premise of a move through 1,300 to maybe 14.5 seems to be in play. If the 1200 gives way and it becomes a little deeper correction, 1170 would appear to be the significant support level before it might be capable of its next big run. But for now, it's a healthy market. The miners are doing exceptionally well. I mean, the GDX up about 35% from its lows, and on the Canadian side, the XGD up about 39%. So clearly, this is a sector that is just outperforming by a long shot in terms of what's happened for the rest of the market.
Can we credit the gold miners for keeping the venture exchange on a positive note when other markets were going down?
Well, oh yes. I mean, and take a look at, the Canadian market as a whole is outperforming the U.S. market. It was, for all that the U.S. has retraced, as I say, 38% of its decline. TSX has retraced 50% of the decline from last November, December, and a full 38% from the actual highs a year ago. So this, last year was the year for the Canadian market to be under significant pressure, and mostly because of the resource side. And the juniors definitely at the top of the list there in terms of negativity, and they're now getting their time to shine once again.
By the way, do you have any more charts or reports on gold coming up?
Well, the interesting thing this week was the commitment of traders' numbers for gold, and we saw some pretty big jumps, about to 19,000 in the speculative positions and 27,000 in terms of new net shorts by the commercials. I have a graphic on that we can present to people, but it's probably a few weeks away from a danger point, but it is worth keeping an eye on.
Thanks a lot for, okay.
Yep, so they could send me an email at ross.clark@cibc.ca.
Thanks a lot, Ross.
And we'll see you again next week.
My guest has been Ross Clark, Investment Advisor at CIBC Wood Gundy in Vancouver. Coming up next, Rick Ackerman, editor of Rick's Picks on This Week in Money.
Always consult your investment professional before making any investment decision. Unbelievable harmony, spectacular performance, the ultimate tribute to the Everly Brothers and Simon and Garfunkel. Bird Dog and the Vintage Electric Band coming to Fort Langley, Mission, White Rock, West Vancouver. Buy online and save at ontourtickets.com.
My guest is Rick Ackerman, editor of Rick's Picks. Rick is a new guest to This Week in Money. His website, rickackerman.com. He's speaking to us from Superior, Colorado. Well, welcome to the show, Rick.
Thanks for inviting me on, Jim.
Well, first of all, can you tell us about Rick's Picks?
Well, I've been around in Rick's Picks form for about 13 years. Prior to that, I did a forecasting service called Black Box Forecast, which was geared to, it was custom forecast for groups of options traders on the CBOE and the Amex. My background includes 12 years as a floor trader on the Pacific Exchange, so I was not new to the options game. But Rick's Picks has been out for since 2003, and I try to put out some actionable trades in stocks, commodities, sometimes options, index futures for traders of all levels of experience. So I put novice trades out there that anyone can do, and some of my stuff is what I would call expert slopes. And my forecasting method is purely technical. I use a system that I've developed over the years called the Hidden Pivot Method, and I offer a monthly course that teaches that method. So I use, again, purely technical means to forecast stock prices, and I don't try to pretend that I have a crystal ball. I just kind of let whatever I'm tracking tell me what it's likely to do next.
And that obviously means you don't spend a lot of time listening or watching those yell and sell guys, as I call them, on television.
No, my chat room, there's a chat room associated with Rick's Picks, and it goes round the clock. I've got some great traders from around the world, and they get pretty fired up sometimes, and you know, about what the Russians are doing or the Chinese or what Donald Trump is doing on a given day. But to me, none of it matters. I look at all price action on charts as simply what I call impulse legs. And no matter how panicky or hysterical the price action on a chart, it can be categorized in terms of impulse legs that make it easy to make objective sense of price action.
Well, let's start with the gold markets. Is gold still in a bull market that started back in 2001?
Well, if you look at the very long-term chart in gold, it looks great. Certainly people who were long in 2011, in the autumn of that year, when what would seem like a bear market began, they would be pretty weary at this point, and you couldn't tell them that gold hasn't had a nasty bull market. But if you put gold's price action on a very long-term chart, you see that we've had a more or less normal correction of the rally leg that began in late 2008. That took gold from about 680, I think it was, up to 1920, and the correction we've had so far has been down. It's been a little bit more than a 0.618 Fibonacci correction. We've come down to 1046, but to me, the best way to look at this supposed bear market in gold is to see it as merely corrective on the very long-term charts.
Does 2016 or 2017 look like the best year for gold?
Well, I just mentioned that I don't have a crystal ball, so I can't say with absolute confidence, but I have to tell you that I like the move in gold off the recent low. It's something a little bit more than what we've seen or what we've become used to seeing. We've seen many rallies that were just that wound up being no more than a tease, but this one is starting to take on real life, and I have some specific numbers in mind for the April COMEX contract, but it looks pretty good. If we were to get above a prior peak from about a year ago at 1308, that's only about 80 bucks above where gold is trading right now. I would say that there's a pretty good chance that the bear market begun in 2011 is over. I would be almost sure of that if gold could get up to 1393. Again, that's basis the April contract. That would take out a key peak that was made back in March of 2014. So the key to bull markets and price reversals is what I call an impulse leg that precedes two prior peaks on a particular chart. And if those peaks are peaks of monthly chart degree, then you know you've got a pretty significant rally.
Now, gold, it seems to have had a few false starts. Is there a certain moment where we can say, those false starts are over?
We're getting pretty close. I mentioned 1308 basis the April COMEX, as I call that the Matterhorn in my newsletter. And if gold were to pop above that peak made about a year ago, that would be, to me, a very decisive sign that the 4-year, actually it's in its 53rd month now, correction is over.
Do you think we've seen the low in oil, and what do you see ahead for oil short-term and long-term?
I've been predicting low 20s for oil since it was trading in the 60s. And, the problem is that there are so many shorts in oil. Everybody's kind of done the right thing. And, of course, Mr. Market is not going to be handing out easy profits to everybody just because they've made the correct bet. So the result is that the short squeeze rallies in crude have been really ferocious, and just about any kind of planted story can touch them off. And you can see that a lot of the oil producers are both clever and desperate in putting those stories out. The short squeeze story of the last week or so was this idea that somehow Russia and Saudi Arabia would collude to suppress production. But no sooner had they done that and generated a little bit of a short squeeze rally in crude than Iran came out and said, well, we're not cutting back at all. So at the supply-demand level, just one major producer such as Iran that comes online with significant production at the margin is going to make the difference. In other words, Russia and Saudi Arabia can't control the market if a large marginal producer is pumping lots of oil.
Well, plus they said they would cap their oil production at January's levels. Well, for both Russia and Saudi Arabia, that was a record output. So what kind of a cap is that?
Right, and Russia is so desperate for cash right now that it's inconceivable that they would stick to a real cap that actually hurt them, that drastically curtailed production, because even at lower prices, they can keep the cash flowing at least as long as they're selling into European energy markets.
Is the Canadian dollar a petro currency tied to oil, and what do you see ahead for the Canadian dollar?
Well, for better or worse, the loonie really is tied to its natural resource-based economy, and I don't see too much in the way of bullish possibilities for the Canadian dollar. It recently bottomed down near 68 U.S. cents, and I think even lower prices are likely. But again, since I don't try to predict the future, I would say that if the Canadian dollar can pop to around 80 cents, it would have a shot of going perhaps as high as 92 cents. That would be a very significant rally, about 24 cents, U.S. cents above where it's trading now. But I think the Canadian dollar will remain under pressure.
I was going to say, if you wanted to help that pop, Rick, you and your friends could always come up and visit beautiful British Columbia.
I've been there, and I agree. I've had some great touring experiences in that neck of the woods, and I can't recommend it highly enough.
Is the Canadian dollar going to be down in the dumps for quite some time?
Yeah, I think it could trend lower, and you've got company there with the Australian dollar. Australia is so heavily tied to China's economy that it could go even worse for the Aussie dollar than it does for the loonie. The last time I was in Sydney was quite some time ago. The Australian dollar was buying $1.15 worth of U.S. currency, and prices were so high in Sydney, it was unbelievable. You'd get just kind of a lettuce and tomato salad, and it was $15. But I'd like to revisit Sydney now because the Aussie dollar has come way down. We still have a real estate collapse ahead in Australia. Somehow the market has held up somewhat better than, for one, the London market. But I think it's partly because of the tax incentives that have pushed a lot of Australian investable money into real estate. There, I think individuals are required with their retirement plans to put something like 8 or 9% of it into one investment or another each year. So real estate was the popular choice, and that's why I think prices got so pumped, but also why they're so vulnerable.
What about Vancouver's huge real estate bubble, which is similar to Sydney's?
Well, it's really nuts, and of course, it is tied in some part to the Chinese economy. There's been a lot of money repatriated from China to the U.S. and Canada in real estate, and I think it's done with the same sort of carelessness that's put the Chinese real estate market in a bubble. So I think Vancouver's headed for a fall too, but it would be hard. It's hard to tell that. The demand is so strong, but you get where nobody who grew up there can afford to to live in Vancouver, and that's a problem.
Well, yeah, even if you push way down the Fraser Valley, the prices there are unbelievable these days. Yeah,
it's when U.S. Residents go up to Vancouver and price real estate in Canadian dollars, it seems more absurd even than places like San Francisco, where prices are about as pumped as you could imagine them.
What's going to perform better, gold or silver, as those precious metals increase in value?
Well, the current ratio is about 80 to 1 favoring gold, but I think, assuming we've made a bull market low at the recent prices, I could see silver going as high as $55 an ounce, and gold up to my target, I think, is 22.86. At those prices, the ratio would be 4 to 1. So in that respect, I think silver has twice the appreciation potential of gold.
Are you bullish or bearish on the U.S. dollar?
I've been extremely bullish, and it's mainly because my perspective over the years has been that of a deflationist. My definition of deflation differs from the monetarist definition, which I think is useless. They like to say that inflation is an increase in money supply and deflation is a decrease. But I think that's nonsense, that it's meaningless in any case, because we don't really know what money is any longer. There's so many forms of money. So I like to look at deflation and to understand it as simply a function of its chief symptom, which is an increase in the real burden of debt. So it's from a deflationist perspective that most of the things that have happened in the economic world over the last 20 or 30 years have been understandable, including a multi-decade bull market in long-term bonds. But I'm very bullish on the dollar. The dollar index has come off recent highs near 100, trading about 96 now. But I think eventually it's going to test highs made about 12 or 13, actually 15 years ago, down or up around 120. So I think the dollar will be very strong. I think that the very strong dollar will be the big economic story of 2016, because it will, most significantly, it will impact on the Fed story that they can somehow create inflation with lower interest rates and perhaps even negative interest rates. The opposite is true, and I think it was always inevitable that the strong dollar, or let's say some extreme movement of the dollar, would bring the whole house of cards tumbling down. And that's mainly because the dollar is such a huge market that it's beyond the control not only of the Fed, but of all the central banks working together. So I think the strong dollar is going to be what gives the lie to the idea that central bankers can somehow manipulate the global economy and national economies. And the worst part of it is that over the years, there have been a lot of bets made that are implicitly short dollar bets. If you are a borrower of dollars, you want the dollar to decrease in value. In other words, you want inflation to happen so that you get to pay back the dollars that you owe in currency that has been cheapened by inflation. So you can imagine if the opposite happens and the dollar starts picking up in value, all who have in some way borrowed dollars are going to be caught in a squeeze. And when you look at that in a kind of macro picture, you see a quadrillion-dollar derivatives bubble. That is the aggregate total of all this leveraged, hyper-leveraged paper that is, I would say, to put it mildly, very thinly collateralized. And although there are two implicit bets in every derivatives contract, one is essentially borrowing and one is lending, and to the extent that you've got a huge borrower portion of a big piece of the derivatives market is implicitly short dollars, the unwind, or let's say the trouble that lies ahead, will come mainly from people who are implicitly short dollars having to get them back. And you would see this crisis happen in the form of a scramble to roll over short-term loans. The loans won't roll. Everybody, in effect, would have to come up with cash, and that's going to put the dollar in a real squeeze. But you're going to see that this quadrillion-dollar derivatives bubble will be unwound in a way that no one can predict other than the fact that it has to end in smoking ruin.
What's your impression of negative interest rates in Japan and Europe?
Well, what has it gotten them? You know, the idea behind lowering interest rates, at least from the banker side of the argument, is so stupid that when we refer to these guys as imbeciles or crooks or whatever, it's not really much of an exaggeration. You know, the idea that their theory is that if you push interest rates down, it's going to force consumers to spend, and even more ridiculously, it's going to stimulate capital investment. Well, neither of those things has happened in Japan or Europe, and you can see that the lower rates go, the more you have, instead of inflation, you get deflation. Part of it shows up in money velocity figures, mainly because when the governments and central banks play with interest rates, it increases the uncertainty looking out on the horizon. You know, people, consumers, households spend more liberally, and companies invest more aggressively when they have a clear picture of the future. And the opposite is true when the central banks are all screwing around with interest rates. So that's why we've had this deflationary effect, the opposite from the effect intended, with each ratcheting down in rates.
Which currencies do you like and which ones don't you like?
Well, I only like the dollar, and you know, I don't quibble with gold bugs, for one, who recognize that the dollar at a fundamental level is worthless. You know, when you extrapolate out the liabilities of the U.S., you see that we're really broke. You know, we've got this fiction about the Social Security system being sound until the year 2035. Well, it's already bankrupt, and it's just not as obvious because we're really taxing the hell out of income earners these days just to hand over money to Social Security recipients. So the U.S. is broke in 50 ways, looking certainly 10 years out. So that makes the dollar problematical from a valuation standpoint. You know, what is behind the dollar? But it's not economic forces that are pushing the dollar. It's really this mechanical deleveraging that I spoke about earlier, that the dollar is essentially in the beginning of a short squeeze because so many people in the financial economy have bet against the dollar. And you know, the crazy thing, the thing that makes the game so obviously absurd, is that the derivatives market, I use the figure $2 quadrillion, but if you were conservative, even there you'd see estimates as high as $500-600 trillion. But the whole global economy, the output of goods and services for the whole world, is only a tenth of that. So the question becomes, you know, why do you need a financial edifice of $2 quadrillion or $600 trillion to service an economy of real goods and services that amounts to only perhaps 70 or 80 trillion dollars? And the answer is because the primary business of this world is not selling actual goods and services, it's shuffling paper. So that's what we've got now, and I think the day of reckoning is going to cause the dollar to strengthen in a way that goes beyond what most people could imagine.
The S&P 500 and the Dow, are they finishing a correcting phase here, or is this a bounce before they head lower?
Well, my favorite technician, Peter Eliades, got that right. He got it exactly right, and I think he got it exactly right before anybody else got there. He basically looked at the advanced decline line for the NYSE composite, and well in advance of the fact, he predicted a top in what you call market breadth, advances over declines, in late May, and he was exactly right. We had a market where highs over lows were expanding up till May, but at this point, the major averages, the Dow Industrials and the NYSE, could probably rally to new record highs without pushing that advanced decline line above its May 2015 peak. So I think the bear market began then, and I wouldn't be unpersuaded, even if we rallied to new highs, unless, of course, they were very substantial new highs. But it's hard to imagine that, even when you factor in the major sources of buying in the market. There are essentially two right now. One is simply short covering, and I think that accounts for most of the volatility that we've seen. There's just bears constitute the only real buying power, other than companies themselves. You've seen even Google use money, its surplus funds, to buy its own shares, and this has been a huge trend over the years, very supportive of the market. The numbers aggregate into the trillions. There's something like $1.7 trillion worth of stock that has been bought back by companies in the last several years, and that has the effect of increasing the earnings per share as they shrink their capitalization. So those two sources of buying are obviously completely artificial. They have nothing to do with the real economy, but you can see where they're kind of winning the day, even as corporate earnings for U.S. companies becomes more problematical, and that's especially so for the multinationals who have a strong dollar to contend with.
We're speaking with Rick Ackerman, editor of Rick's Picks, his website, rickackerman.com. Rick, what do you see ahead for resource stocks, including the juniors? And by the way, are the techs in real trouble right now, too?
I think resource stocks will continue to be under pressure, the whole resource sector, simply because the biggest buyer at the margin, China, is imploding. I've addressed this idea that China was in a slowdown with an idea of my own that China was not headed into a slowdown. It's headed into a collapse. And this is very clearly brought out in a book that I read not too long ago, and I would recommend. It's by the economist James Rickards, and the book is called The Death of Money. I don't agree with his thesis that the dollar is going to get creamed. I am a deflationist, not a inflationist or hyperinflationist, but he is very good on the subject of China and how the Chinese economy has grown to bubble size, and why a soft landing is not possible. He talks about some of these Chinese ghost cities, and there's so many more of them than you can imagine. And he actually goes into this ridiculous idea that if you build a city, they will come. You just put up office buildings and somehow you generate economic growth that way. But Rickards gets right down to cases and says, you don't fill an office that's supposed to be for think tanks until you create a network of universities around that office. So the Chinese have kind of neglected human capital here and pursued this insane idea that if you build a city with subways and escalators and office towers, that it's somehow going to be economically viable. But the surprise is that there are so many of these cities. He focuses on the ghost cities that are in the Nanking area, but there are like 200 of these complexes around China. But Rickards also points out that the Chinese economy is the mirror image of the U.S. economy, in that 70% of the economy is generated by capital investment, 30% by consumption. Well, the U.S. is just the opposite. We're 70% consumption, 30% capital investment. And the capital investment bubble that this ratio has brought about in China is going to have to be reversed. They can't, you can't be investing in production forever. You eventually have to consume some of it, of what you're producing. So Rickards makes the point that even a well-controlled, well-directed, well-planned transition that would bring China's ratio more into line with that of the U.S. would produce a wrenching economic dislocation, not just for China, but for the whole world.
Do you see inflation or deflation going forward?
I've been a deflationist more or less forever. It started with a book by an economist named C.V. Myers. It was called The Coming Deflation, and although he was a little bit premature, just to say the least, the idea has stayed with me over time. The simplest way to express it is that ultimately every penny of every debt must be paid, if not by the borrower, then by the lender. And what that means is that, you have people out there who think, well, if I get stuck and can't pay my mortgage, I'll simply walk away from it. Well, we think of that debt as having been settled in the way of, the borrower, walked away from it and it ceased to exist. But the problem is that the lender will have borne the burden. If he gets stiffed by the borrower, then it is the lender who is paid. So when we talk about all these unpayable debts that we have that have accrued in the pension system, in particular, we can't really walk away from them. They'll have to be paid in one way or another. And you can see a big example of that the baby boomers understand implicitly. They were supposed to inherit their parents' wealth and be big stock market investors, and everything was going to go great. But as it happened, the baby boomers, most of them they can't even contemplate retirement. It's like we'll be working till we're 80, paradigmatically to pay the pension plans of government workers who retired at 55. So within the pension system, you can see that all of these liabilities that we talk about, the huge numbers that aggregate into the tens of trillions of dollars, we say we won't pay, we can't pay them, but the effect has been that we paid it in our standard of living. We're living in a time where even a couple with a good substantial household income, two working professionals, have to hawk their house just to put their kids through college. And of course that is way different from the 1950s when a single income household could pay the bills of a couple kids, put them through college without going deeply into debt. So that's really kind of the hidden cost of all these debts that we've run up. We paid for them indirectly, but the most obvious way is that we paid by way of a decrease in the standard of living. And of course it's masked by all the electronic miracles. We couldn't have conceived of 60-inch flat screen TVs in every home 25 years ago, but we've got those things. But the really important things, we've actually taken a huge hit. These days, single income households are the exception rather than the norm. Working wives I think a lot of them would rather not be working, but it's a fact of life that two couples have to contribute to household goals, even if they're, putting kids through college, but also taking vacations and having what you might call the good life. So all these debts that we've run up, we're actually paying for them now in terms of a decreasing standard of living, stagnant real wages, and just an increase in debt at all levels, most particularly students coming out of college.
Is the bond market in a bubble, or is this the new normal?
I've been shouting from the rooftops, buy bonds now, long-term treasuries for years. And, in let's say 7 of the last 8 years, you could have had capital gains exceeding 20% per year simply by being in long-term bonds. Most people think, well, how am I going to keep my nest egg working at 2% yields? The fact is that if you're in paper with 30 or 40-year maturity, you're very leveraged to short-term moves in rates now, so that if the 30-year moves down by, let's say, 10 or 20 or 30 basis points, you get a relatively steep move in the price of your bonds. So the capital gains potential from long-term bonds is enormous. I'm projecting 1.64% yields on the long-term bond. We actually hit a high recently up around I think it was 3.28%. My short-term target for the long bond is somewhere down to 2.62%. So I think there's plenty of room for capital gains in treasuries. And no, it's not a bubble. I think, we're in a major bull market, and it's got a lot farther to run than most investors would seem to imagine.
The big elephant in the room, of course, is the debt bubble. I mean, governments, corporations, personal debt, massive. Can we survive it? And what does that mean for, the baby boomers who are already collecting pensions?
Well, as I mentioned, we don't walk away from those debts. If the borrowers walk away, then it's effectively the sellers the lenders who are going to pay the cost. As far as the baby boomers are concerned, they're not exactly retiring in droves at age 65. Most of them realize that just to pay the bills, particularly, medical bills, college tuition for their kids, they've got to stay working. They're not, it's only public employees who are able to retire young. And, so in any case, I don't see any relief for the baby boomers in particular. They're not getting the retirement that they planned on. And of course, with the government manipulating rates down to as low as they have, savers have been cheated out of a fair return. And that's just one other way that we pay for all the debts that we've run up. And no one would have predicted 15 years ago that if you had $2 million in the bank, or $2 million invested in your nest egg, that you'd be living on cat food. If you were trying to simply maintain principal and live off the interest. So, and also you can see baby boomers have depleted a lot of their inheritance simply taking care of their parents. A 1-year stay in an assisted living facility will run between $40,000 and $70,000, and of course that eats up $1 million estate pretty quickly, or a $1 million nest egg pretty quickly, particularly if the parent lives to be 95 rather than dying at the age the actuaries were predicting, 30, 40 years ago. So really, it's just a question of we're paying the price. We've run up all these debts, and you can't say that they're unpayable. We're going to pay them one way or the other, and there are only two possibilities to do that, to discharge those debts. One is hyperinflation, and one is deflation. And I think the hyperinflationists have lost the argument there. It's very clear that the world is getting sucked into a deflationary black hole.
Rick, where can people find out more about Rick's Picks?
Well, you can go to my website, rickackerman.com. There's a sign up there at the top where you can get a free 2-week trial, and the service includes daily actionable trades. I try to, as I mentioned earlier, mix it up so that even novices can get aboard. We took an oil a long position just a week ago in a vehicle that Goldman Sachs ETF vehicle called OIL, and it's worked out very nicely. So I put out trades for all levels of experience, but the heart of the service is the chat room, which is available to all subscribers, and it not only draws great traders from around the world, but over the years, I've done as much as I could to encourage a very helpful spirit of helpfulness in the room. So it's a good place to come and ask questions, even if you think they're dumb questions, because there's some really good people in there, great traders and very knowledgeable investors. So again, it's rickackerman.com. There's a 2-week free, no obligation trial, and that's a good way to get started.
Rick, thank you very much for being on This Week in Money.
And thank you much for inviting me on, Jim. I've really enjoyed the interview.
My guest has been Rick Ackerman, editor of Rick's Picks. His website, rickackerman.com. And that wraps up our show for this week. Thanks to our guests, Ross Clark and Rick Ackerman. And thank you for listening. Comments or questions for the show can be emailed to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of How Street Media Incorporated.